Hi, I'm Jonathan Bays, and this is our September monthly investment market update. The big focus for us in the last 6 weeks, and indeed for all investors with Australian assets, was the change in our Prime Minister. In the last 6 weeks, we've seen the Aussie dollar fall to over a 2-year low, around 71 cents now. And the key reason for that, I guess, is the uncertainty created now from a business capital investment standpoint between whether or not we'll have a Liberal or Labor government come May next year. And with the significantly different tax policies that both parties have, businesses will probably put future plans on ice, or certainly defer their investment until the new government has been determined. Fortunately, a long-standing view of our investment committee has been for weakness in the Australian dollar. We still think there's every likelihood that we'll see the Aussie dollar down to 66, maybe even 67 cents in the next 6 or 9 months. And our portfolios are set up accordingly. Not only are we overweight international managed funds on the equity side, but certainly within the local portfolio, we've got great exposure to companies that will benefit from a weakening in the Australian dollar. A recent recommendation has been in Magellan Financial Group, which is now up over 20 or 25% since we recommended it, but we also have exposures to Amcor and Afterpay, and also the investment management group Pendle, which was formerly known as BT Investment Management. We wouldn't normally draw attention to this, but it has been a pretty strong performance over the last 12 months from several of our portfolios. And this month we'd like to thank Hayden Scott from PIMCO for joining us.
The 12-month return has been slightly suppressed this last year, and it's been more like a term deposit on a net of fee basis. So the main factor that's really influenced this has been a sharper rise in the yield curve in the US. So Donald Trump in February pulled the trigger on fiscal stimulus. So that is at a corporate level and an individual level, there were tax breaks, and so that is the forward-looking expectation for interest rates increased, which meant that your bond returns were slightly suppressed. What that has meant, though, is that the forward-looking carry or expected yield to maturity has increased commensurately as well. So in terms of the global bond fund, for instance, the yield to maturity now is 5.1%. The Australian bond fund is at around 3.6%. So looking fairly healthy. And all the while over the last 12 months, your equity returns have been pretty healthy, and this is diversification 101. It's been almost 10 years now since the financial crisis, so it's fair to say we feel like we're fairly late in the cycle. It's been a Goldilocks environment, so growth has been not too hot, not too cold for some time. And we're not really seeing anything around that would potentially kill a continued recovery off at this point in time. So what do I mean by that? So no overheating of the economy, no massive spikes in inflation, no oil price moves, and no overzealous monetary policy. So in terms of the statistics, if you're looking at the US, there is a 70% chance of a recession over any 5-year period. So you've got to think that we have a recession at some point soon. We just don't think it's over the next 12 months. We think it's probably closer to 2020 and or beyond, and we're also very, very conscious of the fact that picking the timing of these things can be very difficult. We're expecting another potential 4 hikes from the Federal Reserve between now and the end of 2019. The yield curve has become flatter more recently, so shorter term rates have increased, and we're just conscious of the fact that they won't want to tip the yield curve into inverted territory, which more often than not tends to front run a recession. So it's fair to say we spend a lot of time talking about rate trajectory. In our global portfolios, we're slightly underweight duration, without overweight being within the US, given where they're at the cycle. We still tend to favour that middle part of the yield curve. We've seen the 3 of the big 4 banks at least pass on mortgage rate increases to consumers, and that is a result of funding costs increasing, and so that has happened, and that just means that the impetus for the RBA now to move is even less. And if you believe the markets, they're now pricing in the next hike for the RBA being in 2020. So certainly watching RBA movements in minutiae will potentially be a little bit like watching paint dry at this point in the cycle. Unemployment, though, is not too bad. We're at 5.5%, with structurally 5% being full employment. Inflation's running at 2, with target being 2.5. So we think we're looking okay at this point in time. It would be fair to say it's cautious optimism.